Hi guys, so today I'm going to try something different. Okay, it'd be great to get your feedback on how you find this, but essentially I'm going to do this video today in kind of like a seminar format. I've got my trusted companion here, my whiteboard. This is just to give you an idea of what I'm going to talk about, okay, but I had quite a lot of questions and messages from people of how much they enjoyed the financial market article, so I'm going to follow up with the stock market. Okay, and I tried to write this article and I did, okay, but it was just too long, so I thought I'd do a video which will hopefully be a lot shorter, and I'm going to just talk about what I consider the 5 main points that you should know about the stock market. Now, essentially, what exactly is the stock market? Well, if you did read that financial market article, then you'll know a financial market is just simply where we can buy and sell different securities or assets. Stock market, no surprise, this is specialising in the asset of stocks or shares. Now, stocks is more of an American term, where shares is probably more of a UK term. Okay, but don't get confused. Okay, those two words are used interchangeably. So once you hear them, okay, you know they mean exactly the same thing. Okay, now, as I said, the stock market is simply where we are trading shares. Shares are a share of a company. It's one of the most forgotten things in this area. Okay, if you buy a share, you are a legal owner of that company. Now, don't get too happy there, okay, because most companies have billions of shares. I think Lloyd's Bank is around 65 billion shares issued to the public. So if you own one share of Lloyd's Bank, you're going to be a very, very small investor, but you still will be a legal owner nevertheless. Okay, so this is what, when we start talking about the stock market, this is what we're referring to. We're just talking about a market that is buying and selling stocks. Who is buying them? Well, you and me. Companies, okay, people, large organizations. These type of people, okay, are fueling what is making up, okay, the stock market. Okay, so number one, what is it? Okay, it's where we buy and sell stocks. Okay, point number two, why companies issue shares? Well, companies need money. Okay, no surprises. I hope that's not a surprise. Okay, but companies need money for different things. They need to be liquid. Okay, they need to pay their employees. They need to buy certain merchandise. They need to pump money into R&D. Okay, and there are limited ways of how a company can get that kind of money, okay, for a particular purpose. They can use organic growth. Okay, now not every company is as organic, if you like, as Apple, who is cash rich. Okay, they might need to go to a bank. Okay, now obviously going to a bank and asking for hundreds of millions of pounds to borrow is going to come with quite a hefty amount of interest. Okay, especially when interest rates are so high at the minute. If they don't want to go to a bank, okay, they can borrow from the public. This is referred to as bonds. Okay, if you buy a bond, you are loaning that company money. If a company is selling a bond, they are asking for a loan. And it works exactly the same way as if you're going to a bank. Okay, if you are lending someone money, okay, so buying a bond, you're going to expect interest back and the principal at some stage. Okay, now we're not going to talk about bonds in this. This is obviously about the stock market, but the stock market is the fourth way of how a company can raise money. Okay, they are selling ownership of that company. Okay, and if you buy it, you are obviously becoming an owner, as I've already alluded to. But that's why companies sell shares. Now, if they're selling shares to raise money, why on earth would you be buying, okay, shares from that company? Well, obviously, if you're an investor in a company, you have a belief that you're going to get a greater return, okay, than your principal investment. Now, you can get a return in one of two ways, or both if you're lucky. From a greater capital return. So in other words, if the share price goes up, you could potentially sell those shares for more than you bought them at. Okay, that's called a greater capital return. Or the company could pay a dividend. Okay, some companies, okay, a lot of companies in fact, do both. A dividend is just, okay, your interest for owning their shares. Okay, now companies do pay 2 dividends per year. Okay, one of them is an interim dividend, the other one is a yearly, okay, or annual dividend. Okay, but collectively you would get 2 dividends per year. Some companies like Glaxo do pay quarterly dividends, but essentially the annual dividend, okay, is just split up into more payments, okay, where other companies will simply pay that annual dividend in less payments. Okay, but both come to the annual amount they're going to pay you. Okay, now essentially that is why you would invest into the company. Okay, you might be trading, so you may not be interested in that dividend. You may be interested into a short-term gain that you believe the share price is going to go up, or if you're going to short the company because you believe it's going to go down. Okay, you just want to make a quick capital return. Okay, and that's why you would buy company shares. Now, number 3, the LSE. The LSE is just an acronym for the London Stock Exchange, and that's a primary exchange in the UK. You have the New York Stock Exchange, which is a primary exchange over in America, okay, for stocks. You have the NASDAQ as well. You also have the Euronext in Europe. You've got the Tokyo Stock Exchange in Tokyo, and many others around the globe, okay. And being the primary exchange in this country, this is where we will find shares to trade, okay, in whichever companies that are public. Okay, now saying that, can any companies, and I've probably just given this away, but can any company trade their shares on the LSE? Absolutely not. You need to be a public company. Okay, private companies are not able to sell their shares, okay, to the public because, as the name implies, they are private. In order for a company to get their shares on the LSE, okay, they need to go through an IPO. So the IPO is the initial public offering, okay, but it's a fancy term for the transition of a private company going public. And they can go through their IPO in 1 day, 2 days, 3 days, okay. I don't believe there's any time frame for that company to start selling their shares to the public for the first time. But if you were to buy, okay, shares whilst they're going through an IPO, then you would be buying those shares directly from the company in what we refer to as the primary market. Okay, so if, for example, I think it was Darktrace that did their IPO over 24 hours, but I do know some companies, and I can't think of the names off the top of my head, that have 3-day IPOs. But whatever it is, let's just say it's Monday to Wednesday, it's a three-day IPO. If you were to buy shares from that company in that time frame, then you would be, okay, buying shares directly from the company in the primary market. You're not able to sell them yet, okay, because they haven't finished their IPO. But on the Wednesday, they finished their IPO, so Thursday morning you are able to now start selling them, okay, to other willing buyers. So now they are tradable, okay, on the secondary market to the general public, okay. Now, the LSE, okay, there are 2 different markets within the London Stock Exchange. There is the main market, then there is what we know more, well, it's more well known as the AIM market, but it's the alternative investment market. And as you can probably tell, okay, the AIM market is the alternative place where companies that aren't able to go on them in the main market to sell their shares, they have a place where they can sell the shares, okay, to the general public. Okay, now the main market is highly regulated, okay, and generally speaking, okay, that these companies, okay, are older, okay, and more profitable, bigger companies than those on the AIM market. The AIM market is loosely regulated. The only piece of regulation they really need to abide by, okay, is they need a nominated advisor. So it's a little bit of a riskier market because companies have been known, okay, to fraudulently, okay, take investors' money who invested companies on the AIM index, okay, where it was a nominated advisor. I think it was Neibu, which was a Chinese company. Okay, they sold their shares on the AIM market, and the nominated advisor actually took the investors' money once they bought the shares and did a runner with them. And as far as I know, he hasn't been caught yet. But okay, I part that to one side. Okay, but just know the main market is highly regulated, and you have to, if as a company, meet certain criteria, certain requirements for your company to be on them. One of them is they need to have a market capitalization, more about that in a minute, of 700 million. Okay, they need to have some others over, I think it's a certain amount in liquidity. Okay, and there's many different rules. Okay, they've got to comply to in order for them to they've got to have 3 years worth of trading. Okay, it actually being a company. Okay, and as you can see, this is why, generally speaking, they're older companies that go on there, because they've got a back trail, okay, paperwork, if you like, of a history of being a company. Okay, rather than if you're a new company and want to start selling shares to the public, you would have to go on the AIM, because you can't meet those requirements to get on or get in the main market. And it's not to say, okay, that dodgy companies go and sell their shares on the AIM. There's been very good companies that have been on there. Okay, most companies, okay, starting out will start in the AIM, but one of the aims, okay, of companies would be trying to get on the main market. Okay, because like I say, this is where, okay, being a highly regulated market, there's a little bit of prestigiousness. Okay, ASOS being a good example. I think it was 2 years ago they transferred from the AIM to the main market, and they had to wait until they met the criteria and wanted to go into the main market. Now, league table. League tables, okay, I'm referring to indexes, okay, because the LSE is split up into various indexes. You will know these, okay, you may not know them as an index, but you will certainly know them as the FTSE 100, FTSE 250, FTSE small cap, FTSE AIM, okay, all these are just simply indexes that make up, okay, the LSE, okay, and market capitalization, okay, is a figure that's worked out by multiplying the share price via, okay, how many ordinary shares they have issued to the public. And as you can see, okay, that market capitalization can rise and fall according to the share price that goes up and down pretty much most minutes, okay, of a trading day. Once those shares have been bought and sold, okay, by any traders or any buyers and sellers. But generally speaking, okay, when the share price goes up, that will move the market capitalization up or down, okay, and therefore, as you can imagine, that company, okay, could move up indexes, very similar to football teams, if you like. Okay, they are obviously playing for points. The more points they have, the more up the league table they go. And just like the end of season, if a football team, okay, in the lower leagues have accumulated enough points that will put them in a promotional place, they will move up to the upper league table. It is just the same as the FTSE indexes. Now, the FTSE 100 is like the Premiership, okay, so it's the top tier. The FTSE 250 is like the Championship in the UK, or Division 1, okay, or the next league down to the top league table in a given country, okay. Now, that again is worked out via market capitalization, and it's also referred to the FTSE quarterly reshuffle. This is where, okay, there is a quarterly reshuffle according to any companies that have risen, okay, so their market cap risen to enough, okay, amount to put them up into the upper league table, or get, okay, relegated into the lower league table. Okay, so FTSE 100 top, FTSE 250, okay, now don't get confused, FTSE 100 is the top, okay, 100 companies on the LSE via the greatest market capitalization. And at the moment, as we speak, I don't know, I haven't seen it for a few weeks, but it's normally AstraZeneca or Shell. Okay, they are the top, or number one and number two, whichever one it is today. Okay, they are the top two companies with the greatest market capitalization on the LSE. Now, since they are the top 100, most people automatically think, well, the FTSE 250 are the top 250. It's not. It's the next top 250. So it's the championship, if you like. Okay, and they are vying, okay, for trying to get promoted to the FTSE 100. Now, obviously, the market capitalization, we know they need to, okay, increase their share price, okay, to a point that it would get them promoted. How do they do that? Well, they need to be more profitable. Okay, they need to try and entice, okay, investors into wanting, okay, to buy their shares, push the price up to the point that they will go up. Okay, and not every company, okay, unfortunately will get promoted, but if, like I say, if the market cap rises, okay, to enough, they will get promoted. And unfortunately, if something comes out about the company that will cause a fall in share price, they may eventually, okay, drop out the FTSE 100 into the FTSE 250 or FTSE 250 into the small cap. Okay. Now, that's, as I say, the league tables. And when it comes to, okay, the share price movements, I've already alluded to, okay, share price movements happen all the time. The more liquid the company, so in other words, a company like Lloyd's, I already said, they've got so many shares, okay, in the public domain, okay, on the markets, then their share price will move up and down, okay, a lot more than companies that are less liquid, okay. Although the movements are generally a bit smaller, okay, they won't go, well, I say this, anything's possible, but generally speaking, unless something horrific has come out about the company or brilliant, so good that the share price will fly up or drop down, okay, the share price is generally quite small, but small movements, sorry. Now, what else causes share price movements? Well, many things cause share price movements, but it all boils down to buyers and sellers of those companies' shares on the stock market. But just to name a few, I mentioned in the financial markets, okay, article around inflation and interest rates, okay. Now, let me paint a scenario for you here, okay. Going back to my financial market article, what exactly is inflation? Okay, now inflation is a measure, okay, of the price of goods and services in a given country, okay, and it's measured by an index called the Consumer Price Index, okay. There are several hundred goods and services in that basket, and it's measured at a particular time frame against the same time frame the previous year, okay, and if it rises, obviously it's more expensive. That basket is more expensive than the previous year's same time frame, and there is a possibility of an interest rate rise. Okay, now we have an inflationary target in the UK, and it's more or less the same around the globe, okay, of 2%. Inflation in general is a good thing for a country, okay, but it needs to be, okay, controlled, and 2% is that given controlled amount that the central bank uses, okay, for guidance whether they need to increase or decrease interest rates or whatever they want to do with interest rates. And it's voted, okay, every 6 weeks, okay, by a committee known as the Monetary Policy Committee, and there are 9 members of the MPC that will vote on what they want to do with interest rates. Now, if, for example, inflation goes above 2%, then it doesn't automatically mean interest rates will go up to bring the interest rate back down to that 2%, okay, but because they're always forecasting the future. So if it goes up to, say, 3%, but they believe in the future it's going to go down to 2.5, there's no real point of putting interest rates up because it's going to be controlled, okay, but on its own. So every time the interest rate is moved, okay, it does obviously cause a little bit of havoc, okay, because in the economy, because banks obviously alter their interest rates according to the base rate of the country. So when I say it causes havoc, okay, there's a lot of things that happen when an interest rate moves. So they don't necessarily want to do it, okay, but they will according to managing, okay, inflation. Now, go back to the CPI, okay, the CPI inside, okay, the index is just basically goods and services, goods being products that we buy on an everyday basis, eggs, I think peanut butter's in there, milk, bread, okay, beef, chicken, all these things, okay, that we commonly buy every day or used every day is inside that basket. So they're commodities, okay, so the commodity markets will have, and I give you an idea of what's going to happen inside that basket, okay. Now, if inflation does rise and interest rates go up, that means debt becomes more expensive, okay, and you'll know this, okay, if you've ever been in debt. If interest rates rise, then the amount you have to pay back rises with it, okay. And if you're a company that has sold debt to the public, okay, via bonds, by the bond market, then obviously that's going to come prohibitively more expensive. I can't even get my words out, okay. It becomes more expensive, okay, for them to pay it back. So that means, okay, that could mean less profits for any owners, and that company's share price might fall because it will cause some investors, okay, to realize that they're not going to get much profits, so they're going to sell those shares, okay, before those actual realization of less profits in the future, okay, becomes apparent in the markets, okay. So that's one way, okay, share prices can move, because if people sell those shares, then obviously the share price will come down, okay, accordingly. Industry trends, okay, obviously for a while now there's been, okay, technology companies. If you think about the top, okay, companies in the world, Google, Facebook, or Meta now, okay, you got Tesla, you've got Amazon, you've got Microsoft, you've got Apple. All these companies, okay, are tech driven companies, okay. So those companies have quite rightly been in demand because their profits obviously has escalated massively, but that is a trend around technology. You can have, okay, certain trends, okay, that will drive companies up and down, and that will change the share price, okay, because as people buy and people sell those shares, okay, share prices will move accordingly. Market sentiment, okay, companies don't have to be more profitable or losing money for share prices to change. If there is a market sentiment, okay, if you think back to COVID, there were some profitable companies, okay, that were still doing extremely well during lockdown. Okay, think about the grocery stores that were able to stay open. Think about the companies that didn't have to shut their doors. They obviously did extremely well, okay, during COVID. So their shares, okay, although those companies, okay, were more profitable, market sentiment was, oh my God, you know, the economy is going to collapse. So therefore, the market sentiment was what we refer to as bearish, okay, and the prices fell, okay. I think I remember seeing several days where literally every single company on the FTSE 100 went down, even though some of them, okay, was going to be more profitable, okay. Now, those are just some of the factors that will change the share price, okay. It doesn't make a difference, okay, what's the driver of the selling and buying. It just, the actual buying and selling of that company's shares is what is causing the share prices to move accordingly. And obviously there are other economic factors. Think back to Brexit, that's one thing. Economic policies, new governments, okay, all these different things can change share prices. Now, guys, it's 25 minutes. It's been way longer than I expected. But like I say, some of these points I really felt like I couldn't take out. So if you're still with me, okay, thank you so much, okay, for staying with with me all the way through. Got any questions, you're more than welcome to reach out to me. If there is anything you want to know more about in this area, please tell me, because I would love to create content that you want to actually watch. But this is what I believe you should know when it comes to the stock market, what exactly it is, why companies issue shares, the key exchange of this country, okay, where brokers on our behalf go and buy and sell our shares, why I'm referring to them as league table, just think back to the indexes, and why share price movements, okay, actually move. So guys, thank you for tuning in, okay, I'll see you next time, take care.